Good evening. This is Doc Severson for the TheoTrade report for Tuesday, November 14th. Okay, you guys have seen the signals I've been throwing at you for the last few weeks. We have major exhaustion at the monthly and now the weekly charts as well too, with a fully charged up daily chart that wants to go somewhere. Is it really going to be able to break above 2600 on the cash S&P index? We also have the same thing showing on the Dow right now, the Dow Industrials. However, we're also seeing the Dow Jones Transports actually leading markets lower as well too. So not only that, but also we're seeing the Russell 2000 has been in the same condition that we're seeing now the Dow and S&P. That was in that condition just a few weeks ago as we had all that energy on the daily chart with no place to go because of the larger time frame parent chart exhaustion. So what does all this tell me? It tells me, at least looking at these charts, that we're going to be range bound to slightly corrective through the end of the year. Something else that's hitting the charts recently, though, has been the Hindenburg Omen. So you don't hear about this all that much. Sometimes you'll see Hindenburg Omens on the NYSE. Sometimes you'll see them on the Nasdaq. Actually, they've been showing on both exchanges quite often recently. So here's this Hindenburg Omen. I'm not going to explain it here in the video today. That's a great Google search. And it's almost like Elliott Wave, because sometimes looking back in the past, you'll see that a Hindenburg Omen made a great signal, such as in the fall of 2007, we had an Omen signal, and it was the perfect warning signal for the sell-off that was to begin at the end of 2007, early 2008. But then again, we've seen literally dozens of these signals through the last 9 years, and they really haven't done much of anything at all. So to just show you the recent impact of the Omen, this is these are when they've been showing up over the course of the last year. So we had one in mid-March. We've seen them in May, right? We've seen them in late May into early June, and we've also seen them into August. Now, what has occurred through each of these is that we've seen the price go into range-bound or corrective, slight corrective behavior. Slight corrective behavior. None of these have been all that massive, but what we're seeing is a whole string of signals right now. So if you put all this together, you start to look at the charts and say, what is going to be our catalyst to drive things higher into the end of the year? We're actually very close to the 2600 level, which was the upside target for many analysts for the year. So we're almost there. Nobody wants to lose their gains into the end of the year. So this is why I think there's going to be somewhat of a cushion or the dip being bought. This is what we're seeing almost on a daily basis. Every time they try to take it down, shove it right back up again. So this is translating into larger volatility. I talked about ATR before, which is starting to come up from almost a historic low into more of a normal region. So this type of sideways behavior does spawn typically larger sideways behavior in larger time frames and could kick off a little bit more of corrective behavior. Now, I'm not going crazy and saying that we're going to be selling off or anything at this point. I don't think so. I think if anything, we just build up a bigger range. We stay range bound into the end of the year because right now there's just no catalyst. We know what's going to happen through the end of the year. We know that with a 91.5% probability that we're going to see a rate hike in the first meeting in December. I mean, could we have a blowout jobs number? Yes, we could have a blowout jobs number that comes in early December, but then again, a blowout jobs number just means that perhaps the Fed is a little bit behind the ball and needs to raise rates a little bit faster. So now we're getting into the situation where good news may be viewed as bad news for the first time in years. Now, my parting thought here is that don't forget that market moves start from the inside out. So you can barely see this volatility that's up here. It's so small, but yet we think it's so big just because on a relative sense, it is much larger than what we've seen in months. But don't forget that we could get into this type of volatility very, very quickly, but it would start from the inside out. So what starts small and starts to expand eventually starts to propagate towards larger time frames and even larger time frames. You can see that looking back here, these look like very normal pullbacks in the midst of an uptrend. They were not normal pullbacks. At least it didn't feel like that when you were going through it. It felt like a full bear market and a full sell-off. So this is almost what we're due at this point, is just to move into a larger range, anticipate that larger range, and use it as opportunity while everybody else is freaking out. That is it for tonight's report. Thanks for listening. We'll see you tomorrow.